Good morning, good afternoon, everyone. Welcome to the Simpactful webinar on Follow the Money to Profitable Revenue Growth. Thank you all who have joined so far. We're going to wait another 2 minutes to launch the webinar or start the webinar till everybody's on the line. So please hang on with us. Looks like we've had a few more people join. Good afternoon and good morning, everyone who's joined. Thank you for being with us. Welcome to this Impactful webinar on profitable revenue growth. Thank you for joining us. We're going to wait another about 30 seconds to go ahead and get started. So please hang tight here so we can give everybody a chance to join. I am going to pull up. Okay, everyone, let's go ahead and get started. Good afternoon. I'm David Friedler, managing partner here at Simpactful, and we're very excited to have you join us for our webinar today on basically how you follow the money to drive profitable revenue growth, something we know that is critical and near and dear to everyone's hearts and minds today. A few housekeeping topics or few housekeeping pieces just to let you know. If you haven't done a webinar like this, this is more of a one-way communication. We're not able to see you, and there's no chance for you to ask questions coming online or on screen. However, there is a Q&A button that should be on your Zoom toolbar. And if you have questions, please submit them there. We will see those, and we do have plenty of time set aside in order to answer those questions. The second thing, hopefully you got a notice when you joined, we are recording this webinar. So not only will that ensure it's available to you or colleagues of yours later, but also just means as an FYI, we can't see you, so you're not being recorded, but it is a recorded session to make sure everybody's aware. And then at the end of this, as I just said, we will distribute the link to this. We've created a Simpactful YouTube channel to post this webinar along with other ones, and we will get this out to you when we're done. Okay, so let's go ahead and get started. First and foremost, let me introduce the panelists who will be talking today in the session. First and foremost, Nancy Brown, formerly with Duracell as their North American CFO, as well as P&G finance leader. Second is Phil Morris, who also spent time at P&G, but was more of a sales leader in the trade and trade investment space and strategic go-to-market expertise. We're also pleased to welcome Jose Rodriguez, experience at GSK, Novartis, very much in pricing and overall brand and strategic pricing. Craig Simon, formerly with Campbell's, Mondelez, Kraft Heinz, as a broad RGM and go-to-market expertise along a number of categories and distribution networks. And finally, Mike Tolkowski, having been at Mars in both marketing, sales, and RGM over the course of his career. So as we go through, each of these individuals will be speaking and sharing their background and experience and examples, I should say, of our revenue growth opportunities that we see to help you to drive better net profitability. And all will be participating at the end of the call when we open it up to the Q&A to share their experience as well. I think I forgot to mention up front too, we have about 25 minutes of content to share out with you, and then a good 15 to 20 minutes of Q&A. Our goal is to be done no later than quarter till the next hour, so we give you some time back in your schedule. So there is plenty of time for Q&A, as I said at the beginning. So please start to share those questions as soon as you're ready. A brief intro on Simpactful. Our firm's been around 8 years. We are a consulting advisory firm in the CPG space. And as you just saw from the introductions of the individuals on this call, our team is represented by people who have been at a broad cross-section of the industry, as noted on the logos that you see on the left-hand side of the screen. What you'll see is everyone on the call today has experience on the manufacturer side, as I already said, with companies like Duracell and P&G and Mondelez and Mars. But you'll also note that our team extends to individuals who've been on the retail side, as you see logos there for Walmart, Target, Kroger, Amazon. And so we really like to think that our broad industry expertise keeps us very proven in our ability to work with you and help you on your needs, very connected, very balanced with both sides of the desk, and ultimately very results oriented in making sure you get net benefit from any projects that we do with you and are a great value. For our broader company, we tend to focus against 5 different core capability areas. Those are listed across the top, and then segments of each of those are listed within each, from strategy to marketing to sales and revenue management to operations, and then to ultimately org development, training, and change management. Today, we're obviously talking about what's in the middle bottom bucket around revenue growth management, but we are able to talk on any number of these other topics and would be happy to do so as follow-up if there's interest in any of these going forward. And so with that, we're going to shift our focus and get into the topic at hand on revenue growth management. And with that, I'm going to turn it over to Mike Tolkowski.
Thank you, David, and hello, everyone. Whether you call it RGM, SRM, NRM, revenue growth management is big, and the stakes are very high. And if you focus sort of on the left side of this slide, what is the role? Where does it play? Well, one, it's a fundamental capability that most organizations, certainly best-in-class organizations, have to drive profitable growth and capture value, not just for themselves, but for their retail partners. And more specifically, RGM is very much about net price realization, trade investment productivity, and portfolio mix. And that's usually the simplest way we define it. And for those of you who are more P&L inclined, the bottom left just shows where each of those disciplines sort of impacts your P&L across the board. And it's not a bad way to think about how they're all integrated and why they're together. It's a discipline that has been around for a long, long time, but probably over the last 15 or so years, maybe even a little bit more, it was a sexy title put together on RGM or SRM. And, the disciplines of pricing have been around, trade investment around, portfolio have been around for a long time, but they've never really been integrated together as they are before. And this is about following the money. I mean, pricing certainly is the biggest financial lever for most companies in their P&L. But as you all know, with all the recent pricing action going on, it's harder to pass these all along now. Trade, for most of you, is typically either the largest or the second largest line item in your P&L. So it's like too big not to understand or notice. And in many cases, we've seen trade productivity have been declining. And as I sort of mentioned before, a lot of cost inflation, certainly across the pandemic, while it's slowed a bit, it's still probably in that 5% range, and it's certainly pressuring most CPGs and everybody's P&L. And of course, for those dealing with retailers every day, know that they're smarter, better, and more demanding than ever. So again, we'd like to say the stakes are very, very high. And David, if we go to the next slide, we see sort of 4 big trends going on over the past few years. The first one, a much more renewed focus across the industry on net price realization. I mentioned there's been multiple price increases across categories to keep up with inflation, a reinvigorated focus on trade ROI and trade productivity. We've seen a lot more in the space of advanced analytics and artificial intelligence for both pricing and promo decisions. A lot of good focus on mix management. In fact, these small improvements in mix can yield quite a bit. And a lot of the industry, a lot of our clients are premiumizing their portfolio. So looking to trade up, you will, on on that particular part. And of course, many clients are internally looking at their trade terms, their price curves, their pack price architecture, and they're looking at this by channel. So that renewed focus on net price realization is very big. For those of you who are participating or winning in the Marketplace Council, you'll remember this the channel shifting that's going on. So we've seen a huge shift. It's sort of exacerbated during the pandemic to obviously e-commerce, value or dollar stores, and club. And we've seen that for many in the CPG industry, that's had a negative impact on profitability. So a lot of work going on there on how to address that. We're doing a study right now on required retailer investments. So these are things beyond your normal, organization investment in or trade. These are things such as, data, fines and fees, retailer media, e-commerce, buy online, pick up in store. All these kinds of fees have certainly skyrocketed in the past 4 or 5 years, and that's impacting P&Ls and creating tough choices for many CPG companies. And last but not least, with a big focus on category profit pools, customer P&L capabilities, understanding the profitability for each of your customers is really, really important. So we've seen that in helping set strategy, strategic priorities by customer channel, and where to make investment decisions, because most companies cannot afford to spend deep with everyone. So you got to make those tough choices. So these are some of our biggest trends that we see in the marketplace right now. Dave, I think we're ready to go to the next slide. And we have a couple of examples of these areas. And I think you'll see how we've sort of been able to add some value in looking at these things. And the first one is going to be led by Jose to talk about pricing. So, hey, Jose, I'll turn it over to you.
Great, thanks, Mike. So our first case study is regarding a leading skin health brand. This brand is market share leader and facing, double-digit cost inflation, as I'm sure many of you have and many of our clients have as well. Importantly, they had recent product innovation that put them at parity with their number 2 player, which was their key competitor and the fastest growing player in the market. And their pricing was below this key competitor. And that pricing was being exacerbated somewhat by comping. Now, this comping, as we dug into some of the data, we realized was also somewhat impacted by the price pack architecture, and they lacked some level of SKU differentiation from a channel perspective. So that was exacerbating some of the comping situation. There were also profitability challenges, both internally from a company perspective and with retailers. Their large size packs, their discount curves were way too steep, leading to margin issues internally, and their retailer margins were below average across the board. So obviously they needed to take a price increase overall, but we also importantly look at things holistically and try to also address some of the structural issues and challenges to maximize net price realization or profitability across the board. So a bit on our approach, we do take a cross-functional approach and holistic approach as we both look at the recommendation and develop the selling story to look at beyond just the cost justification. In this particular case with this client, we highlighted the significant amount of innovation, product innovation that improved the product performance significantly, as well as very significant investments in supply chain and media as well as we develop the selling story. And as we work with clients, we really try to leverage existing mechanisms, in this case, pricing steering committee that helped facilitate a really quick alignment on some of the key decisions that needed to be made. So our recommendation included an updated price pack architecture, obviously a list price increase associated with that. We recommended parity suggested retail prices, so we addressed the pricing disadvantage that was in the marketplace and at the same time improve customer margins. And this was coupled with a revised price promotion guideline, again, addressing some of the structural challenges that we identified in our analysis. This was all pressure tested with our Simpactful retail expert panel to make sure it was executable, identifying any areas of opportunity and potential pushback from a retailer perspective. And this was all incorporated into custom sell-in presentations for the top retailers. And the results, you can see them there. Very excellent execution of an LPI across 3 of the primary brands in the largest market. The price gap versus competition was addressed, and profitability was improved both for the retailer and for our client. And again, improved net pricing opportunity and maximizing the price pack architecture across the board.
Great, Jose. Thank you. Folks, if there are, again, questions that you're going to have on any of these or anything specific, feel free to start to feed those into the Q&A, where we'll be able to see these and then ultimately be able to respond, as I said earlier, where we have plenty of time to go through and talk through any of the questions. So with that, we'll move to our second case study.
Thanks, David. This is Phil Morris. Thanks, everybody, for joining today. I'm going to be talking our trade program simplification and efficiency project that we recently completed with the client, and they're into the second phase of implementation of this project. Just a little background of what led to this trade simplification project. This client had just launched and had worked with their field sales to work with an Exedra and that in a trade fund system. They were working to get 1 year of data so they could get better forecasting, better planning, and start doing some ROI efficiency work. So that was kind of underway when we came in. They just stood up an RGM organization, SRM organization. They were focusing a little bit internally on spend to get that more efficient versus externally with the customer teams. And trying to bring that efficiency along, they'd also changed their annual goals to more of a gross sales and a kind of a light customer team P&L. So they were making the steps toward being more efficient and targeted when we came in and looked at the trade fund system. This spend was their number 2 gross to net spend in the organization. So there was a lot of opportunity to get more efficient. They were kind of in an outdated mode where they really weren't designed to accelerate growth. By that, I mean, their accrual rates were literally focused on fair and equitable. Everybody got the same rate, whether you were growing and more profitable or declining and less profitable. So their desire was to move to fair and justifiable within a customer segmentation model and trade rate differentiation. Talk about that more in a second. There were some disconnects between their business units, sales planning and finance, and account teams. While sales planning and finance kind of sat in the middle, the business units kind of wondered, were they spending the money where our strategy choices were? The customer teams are wondering back to the business units, where were they spending their demand planning or their demand creation dollars, that they really understand the role of the retailer in the business unit. So we really need to clean up that communication transparently and build some trust within that. They did have an enterprise-wide customer segmentation model. However, they chose the top 7 customers, but they applied that across all the business units. And they had very diverse business units in their total enterprise, and probably that segmentation model of the top 7 didn't apply really to half of those business units where their top 10 customers represented 80% of the business. So that segmentation model didn't really apply. They had very complex spending buckets. They had 4 different buckets. They annualized a lot of that spending year to year with the base rate. They kind of filled it in with a lot of TFIs, TPRs, some meat comp spend. So that was very complex and hard to administrate. And their annual planning was very, I call, template driven, exercise driven, 15 to 20 templates presentation versus really sitting down, discussing the business and challenges and aligning to annual goals. So those are some of the challenges we faced. We interviewed over 35 internal and external content experts, and this really was across sales, internal sales, BUs, finance, product supply to really understand the current situation. We took that content, we compared it to our best-in-class approach that we've designed from benchmarking 35 different CPGs from startups to multi-billion-dollar national companies. And we really gave them a range of size of prize opportunities and how to really implement those based on priorities, and laid out really a timeline of how they can go capture some of this efficiency. We did identify 5 areas of opportunity as well as sequencing for them. And just so you know, we started this project 4 months out from when they had to release their rates for the next fiscal year. So we did this in a very compressed schedule. We got them kind of a year one, what they can go and get early. They're in phase two of that right now. But here's where we really focused our attention on is improving that annual planning and trade funding process on the top 10 customers by business unit to identify, where they can really accelerate growth. We built more trust, more discussion around the opportunities and locking in those annual plans. We designed one harmonized trade architecture across all the BUs for consistency and implementation. We did move them to a 3-tier segmentation. However, those business units could choose their own criteria to segment and also what customers they wanted to include in that. We did move out for better planning and investment. We moved out the release dates of all their demand creation spending to include trade to better align with customer calendars as well as their own internal fiscal year planning. And we went from 4 spending buckets to 2 to, again, be consistent, be simple, easy to track. And if you look at the ranges of efficiency we found on their total trade spend, we found between 2.5% to 5% of trade productivity that they could really segment and go after accelerated growth. And when you look on the cost of our project versus what that financial gain was, that was about a 10 to 1 payout on the investment with Simpactful to identify those efficiencies and productivities. So David, that's all I have right now.
Well, wonderful. Thank you. And thanks to those of you that are submitting questions. We've got 3 in already and appreciate any more coming through. And with that, I'll turn this over to Craig, I believe.
Thanks, David. Appreciate the opportunity. Craig Simon here. I'm going to talk to really improving trade investment with EDLP pricing. And this is not a specific case study of a project, but really about applying a best practice to your trade optimization toolkit. So from a challenge perspective, we all know that the retailer world that we live in today is significantly tilted to EDLP pricing, or certainly hybrid customers that has an approach to retail pricing that includes both EDLP and promo. It's more the rare customer today that does most of their promotional activity on promoted pricing every day. At huge customers like Walmart, you may be spending 100% of your trade against EDLP pricing. And across the mix of all customers, many CPGs these days are spending well north of 50% of the overall trade spend against EDLP programming. Now, the base incremental paradigm that's used typically in today's syndicated world to enable trade analytics works great against promotions, but really has a hole when it comes to analyzing EDLP spends, as most of that EDLP consumption goes into the baseline, and it can greatly understate the ROI on this activity, or worse yet, the trade analytics just aren't even getting done against what is a very significant spend of dollars. As the trade investment in EDLP continues to increase, it's really increasingly important to fully evaluate and improve this spend. So the approach really, I want to talk to 3 things. Number 1, and really underpinning the whole approach, is adjusting the baselines on a customer and promoted product specific basis. So by making one key assumption and then applying price elasticity work, the baselines can be adjusted, which hypothetically lowers the existing baseline and creates a third slice of consumption that we can call EDLP incremental, if you will. So now EDLP investments can get full credit and insights can be generated to enable some work against this activity. I will tell you that even with this approach, EDLP investments typically do generate lower ROIs than promos, but still they're better than typically looked at, and it's a topic that we need to talk to customers about. With that work completed, your customer teams can now really approach doing analytics against 100% of their trade spend wherever they've got the syndicated data. And they can be doing that on a regular basis, along with, importantly, reviewing that information with their customers on a regular basis in their customers' metrics. So going in every single month, or at least on a quarterly basis, and ensuring that the trade ROI and the impacts of all that trade investment that's being made with that customer are understood by that customer in terms of their sales and their profit. Now, typically, I speak to some of the results that can come out of this, but there's really two big opportunities. One is to improve the trade ROI against that EDLP investment, and that can typically be done by execution. Lots of EDLP spends are associated with some degree of customer display, or certainly enabled by field execution. And the display lifts are significantly better than when you're running pure EDLP off the shelf. So the first big opportunity, especially working with the customer, is to get more performance even against the EDLP spends. Sometimes the EDLP spends, and quite frankly, the customer retails, are both pretty attractive in the marketplace, and sometimes can even get some feature activity, but certainly display activity can greatly increase lift and trade ROI. You can also just sharpen your field's focus on executing the events. The other big way to really improve trade ROI is to shift some of the spending from EDLP spend into more promoted spending. So again, as you dialogue with the customers, even sticking with their strategies and delivering against their KPIs, many times there's an opportunity to tweak some of the EDLP pricing and take some of that investment and drive some more promotions that also that tend to drive greater trade ROI. So there's a real opportunity to act against what has become a very significant spend and really increase the ROI by ensuring that this work is really looked into and examined as deeply as all the promo spending out there. That's it, David.
Great. Thank you. Mike, back to you.
Yeah, I thought, as we sort of wrap up before questions, just to give you a flavor of some of the things we do, the different kinds of projects and engagements we do. And we like to use the word fit for purpose, because in any one of these areas, we can take a part of it, we can be very surgical, or we can very, very broad. We'll sort of tailor the project to your particular need. We do a lot of work in the benchmarking space against each of the pillars and each of the best practices. We've helped many clients create their strategic plan for an RGM capability and sort of roadmap, a lot of work on size of prize. We do portfolio optimization from very simple quadrant analyses. We actually help clients then do action planning. How do you convert what's the analysis into action plans? A lot of work in the strategic pricing. That seems to have been a lot of our work in the past couple of years. And we go through, pack price architecture, sort of Jose mentioned. We even get to cost to serve or efficiency programs, so bracket pricing, as well, of course, doing things and helping companies think about list price increases and how to best execute them. The example that Phil just went through, we do a lot in the trade architecture area, look at the entire gross to net, benchmark versus other companies, your categories. We do a fair amount of program redesign as evidenced by what the example that Phil shared. And I think in each case, certainly the first two, we leverage our retail panel quite a bit to pressure test our thinking as you get to execution. And, we like to say, nobody sees your strategy or analysis, all they see is your execution in the marketplace. So we do a lot of that. And of course, we then help teams with how to deploy and change management. Of course, ROI analysis from the most fundamental, and we do some work in the space of the more sophisticated advanced analytics, and certainly do help companies figure out what kind of TPM or TPO tools they should consider. We don't actually offer the tools, but we help people assess them. And of course, we do a lot in this space of customer profitability, strategic channel management, and of course, general best processes and systems. So this gives you a bit of a flavor for the different kinds of things that we've done. And again, as I said up front, we can take bits or pieces of that. And sometimes we have clients that do like the whole smorgasbord, but we often just dive down in a particular area. So hopefully that gives you a sense. the kinds of things that we have done. And I think, David, we're ready for some questions.
Yeah, absolutely. Again, folks, we've got, I think 6 questions teed up that we'll go through now, but if there are more, please enter them into the Q&A. First and foremost, we've gotten a question here around setting up a customer P&L to really assess your business, the brand's business, on a customer by customer basis, on a much better net P&L ability. So we're not talking about the retailer's P&L, but a brand's P&L at their top retailers, how you structure it and set it up. And so the question is, what are some of the key areas best-in-class companies have put in place to do a customer P&L very well? And so with that, I think I'll ask Nancy Brown to share some perspective here.
Yeah, sure. Hello, everyone. Nice to see you this afternoon. So as we've done this work with a couple of clients, the work is really a lot broader than simply creating a customer P&L and getting the data, right? Many clients that we speak to do have customer P&Ls to some level, oftentimes to the gross margin level, which is good, and it's nice to have the data, but the magic comes when you can really expand that and look at it much more holistically. And that's where it becomes really a selling strategy that you can use to negotiate with your customers and improve your relationship. So as we've done the work, there's kind of these 6 big buckets that we focus on. So I'll just kind of go through those and give you really brief context on that, because I know we have other questions as well. But, the business culture is kind of the first one, which is really important to make sure that there's a focus across the organization. And really, the second one is the total business model. So making sure that customer P&L is at the forefront of how you make decisions and incorporate it in kind of to the daily business model. Systems and technology, many people have these offline tools that they create after the fact in Excel. So really trying to figure out how to make it a real-time system, leveraging technology to be able to have the data as accurate and as real-time as possible. The fourth one that we always talk about is training. So the idea here is, because it's part of the entire organization, not just a finance exercise, that it really requires a lot of training across the broad organization to how to leverage it. What does it mean? What are all the elements within the P&L? The integrated business process, again, this goes to when you're planning multiple years out, or even the current year, that the P&L is at the forefront. And then the last one, which is probably my favorite, is around accountability. So how do you leverage the customer P&L to truly drive accountability to the business results that you want across the organization in a consistent manner? So all of those things together is what we believe kind of creates the magic and the powerful P&L that can be used to negotiate with your customers to drive better business results and improve the relationship.
Well, Nancy, thank you. And as a seasoned finance leader, I'm not surprised that you would tell us that accountability through the sales organization is a critical outcome, and one that you love the most. So
Okay.
It's very fair. It's very fair. As a lifelong salesperson, let's say it's very fair. Hey, next question, folks. What indicators inside a manufacturer's business will indicate that there is an RGM opportunity? Is it possible to be growing sales and share, but still have an RGM opportunity? Mr. Tolkowski, can you help us there?
Yeah, absolutely. And this is actually a pretty common situation, and almost like a false sense of security. And if you remember back to that, one of the first slides we put up, when we look at net price realization or trade investment productivity, that's where it would come to bear. So think about it, net price realization. If your net prices aren't increasing at the same rate as your costs, even if your sales and share are growing, you probably have a financial pinch. And that's where you pretty much have to look at, what's going on the pricing side in particular, as well as on the cost side. And all of the RGM levers can help you improve that. I'll call that profitability. So you want your net pricing growing at least at the same rate as inflation. And there are a number of different levers, which we've helped clients, figure out what's the right lever for you. That's the first one. The second one is the one we see a lot. which is trade investment line. So I'm growing my top line, I'm even growing my share, but my trade rate or trade line is growing faster than my sales line. That means your shape is eroding and it's probably not a sustainable proposition. So getting better at trade investment productivity, continuous improvement every year, 2 to 3 to 4% every year is probably a good goal. And that would be another example. You probably have a pretty sizable RGM opportunity, given that trade is so big, biggest or second biggest line item in the P&L, to say, even if I'm growing top line and share, I probably need to look at RGM.
Mike, great, thank you. And again, if whoever asked that, if you would like more insights there, as is true for any of the questions or any questions not asked, please reach out to us. In fact, I will put up the next steps options for you here to reach back out to us. So another question, in this case for case study number 2, and for Phil, you talked about improving communication between the business units, the planning teams, and sales. Can you elaborate on what you uncovered so others can be on the lookout for watch outs or on improvement areas?
Yeah, David, this, I would say I can't emphasize enough when I worked at Procter and also being in consulting for 5 years and working with a lot of clients, how important this is. If you do this right, it takes a lot of swirl, finger pointing, a lot of just time investment of kind of connecting all the dots. And when you do it right, your business unit, your sales planning, sales finance, and customer teams really go out and develop one plan, and they know what each other are doing, and they're confident where that trade investment from a BU standpoint, they know where the money's being spent, how they're getting the right return on that, what the customer input's being put back into. And simply put, and David, this is going to be real quick, but in our annual planning process, we've done this as practitioners, we've done it with clients. You really want to, when you segment your business, I know we have questions on that in a minute, but when you develop those BU strategies for that fiscal year, you want to deploy those out to your top 8 to 10 teams. They give you input and to see how far you are away from those annual goals. But at that point, you literally want to bring in a room your general manager, your key business unit directors, the BU finance, the key customer team lead, and some of their CAMs, and sit down and have a discussion. We use a 2-page template for this. It's not 30 pages of slides. It's not telling them stuff they already know, but you literally have a discussion around what the goals are, what the opportunities are, how can they work together. And coming out of that, you have an alignment on what those goals are, but it doesn't stop there. It's a continuing process where you're touching base with that general manager or the VP of the BU. You're touching base with them bi-monthly or twice a month, every couple of months or monthly, because you want him or her to know exactly what's going on. That's where you build up that trust and credibility, and they can pick up the phone and call people, and it's not coming through sales finance or sales planning. There's a direct connectivity through that whole process, and the relationships becomes very positive and trusting. You get a lot more done fast, and when people talk about opportunities, it becomes a lot easier to address. So that's one, is it's just an annual process. It's discussion driven, it's not template driven, and it's building that trust and accountability, like Nancy mentioned before, of addressing growth opportunities, but also closing gaps.
Hey, Phil, thank you. And yeah, I think as one who's been a part of a lot of those meetings, a collaborative meeting is so critical versus it being an inspection of the sales plan or a questioning of the plan. It's a big cultural challenge in a lot of companies to get that right. And that's a big watch out in what was shared. Okay, 3 more questions. And again, we're on pace for wrapping up in about 5-10 minutes, but if there are others, we're happy to stay on with more questions. So Phil, another in your camp. In your results, you noted a move to a 3-tier segmentation model. What are those 3 segments?
Yeah, David, I'll try to answer the other question too. I think how do you determine the top 10 customers? So I'll kind of bring this together. But we really recommend a 3-tier segmentation. This doesn't have to be rocket science. It doesn't have to be complex. It's really what is the strategy and role of the business unit. For example, if you're really having growth in top line and profitability, the criteria you set to do your segmentation is really very flexible. You can focus on net sales growth, profitability, and share growth. Those can be your three metrics. You apply those toward all of your customers, but what you'll see when you do the work, you're going to have probably 8 to 10 customers that are driving that growth from a profit and share standpoint. And that's kind of where you draw the line. That's where you want to spend a lot of your time going deep to help them deliver those accelerated goals in that first tier. In the second tier, as customers probably around 15 or so on average, and they're probably lower, slightly behind the accelerated growth, but they're still very important. They're very profitable. You do want to spend time with them, but not as much. And then your third tier is probably, 90% of your customers, they're probably declining. They're not as profitable. They're very administratively heavy. But I would say tier 1 would be 8 to 10 customers. The next 15 is, when you add those two together, it's probably 90% of the business. And then you have, 90% of the business. And then the final 90% of the customers are about 10% of the business, where you kind of want to just deploy an average rate, a very thorough annual plan so they can go off and do their business. And then you can focus on tier 1 and tier 2. And I think that also addressed, David, that top 10, again, flexibility driving and developing your criteria, depending on what the business unit strategy is, to say, is it 8, 10, 12 customers? We can work with clients to really design that to fit what the BU strategies and role models are.
Yeah, absolutely. And again, I would add, definitely we'd recommend looking at it far beyond just sales or volume only, where you can have a profit metric or other metrics, share development and such. The other thing I think we've seen is companies often find that when they have a very diverse portfolio, it's important to have a top 10 or however many you choose on a business unit by business unit basis, just given the fact that obviously some brands may be very developed in one set of retailers versus another, and oftentimes getting to a top 10 on a corporate basis is not as fruitful as business unit focus.
David, one last thing I'll add, because I want to build on what you said, is that you really want to have somebody in the middle, like sales planning and sales finance, to run this segmentation. Because and this isn't meant to be negative, but what I see is business units try to get it to be 4 to 6 criteria. Once you get past 3 or 4 criteria to do your segmentation, it becomes very, very numbing, if you will, because it becomes too complex. They're trying to get spending in certain pockets. That's frankly is unmanageable, and it's a lot of throwaway time trying to get that, to get that finesse. So we recommend really 3 to 4 criteria when you do your segmentation. Have somebody that can see both sides of the playing field to manage that segmentation and modeling.
Phil, great. Thank you. Okay, our last question went to the third focus area or case study around EDLP. And the question is, can you elaborate on the EDLP ROI you mentioned and how you measure it? Oh, you're on mute, Craig.
Thanks, David. Let me do this. First, let me say that I think, as the amount of trade investment has increased so dramatically, it is truly critical that everybody is evaluating all of that spend along with their promotional spends, really to 2 ends. Number one, we obviously want to be able to increase the ROI there as well and drive more sales and profit for both us and the customer. But also, as you make strategic funding decisions, you truly do want to understand across customers, what do ROIs look like? Typically, as I had said, in the base incremental paradigm that most people use to do trade analytics, most of that EDLP spend, it's just incredibly understated, because all you do typically get any value for is, let's say, the display. You typically don't get value for the price reduction that indeed is the EDLP price, right? Technically, if there was no trade being spent, everybody's retails would be higher, and every customer does kind of discount down to their EDLP level. So by doing the base adjustments on a customer and a promoted product specific basis, where you've got the elasticity data, you literally can adjust down the baselines and create that incremental slice of consumption. So now instead of just base and incremental and use kind of a typical approach against the incremental to understand what the trade ROI or the profit impact of those incremental sales you drove were, you can literally, where you've got no typical promotion, but just EDLP spend, you can actually take a look and use that incremental EDLP slice to do all the analytics. It puts everybody on more of an even playing field, and it basically creates a call to action against a very significant investment that you're making with customers and on behalf of customers to drive your mutual business, to generate some insights, because it's not only knowing the ROI. I mean, at the end of the day, we can always assign ROIs, but we need to strive to understand why. Why was the ROI good? Why was it bad? So what could we do to make it better? And in many cases with EDLP, we do go back and find out that, hey, we were granted a display, but we got 10% of the stores displaying. And let me tell you, just get that number to 50, because trade ROI is a game of pennies. I mean, all of RGM, quite frankly, is a game of pennies. And if you can get a few more, it can have a big impact. So it's a way to adjust baselines to more effectively evaluate across the customer base and at each customer the value of the EDLP spend, both in terms of the reduced price as well as any merchandising that you're getting, and seek to improve it. Again, through either execution, typically display driven, sometimes can even get a feature, which also FO lifts are better than, TPR lifts. And also to talk to the customer and potentially shift some of the funding. You can show them that it's better for you and them on a sales and profit basis to probably reinvest it in promotion activity while still allowing them to execute their strategy in the marketplace. So I hope I at least expanded on that, if not answered it directly, but certainly can follow up to make sure that we do so going forward.
Absolutely, Craig. Thank you very much. Folks, we're almost at 10 till the hour, so we are going to wrap things up here. Thank you very much for joining our webinar today on revenue growth management and driving higher net profitability. You've seen on the screen the contact information if you have further questions. We will automatically distribute this video via a link, so you can watch it again later if you want, or maybe more importantly, hopefully share it with others in your organization. And we'd really love any feedback that anybody has, or examples of things you'd like us to maybe add on in a future session or a one-to-one follow-up. Once again, thanks for joining us, and hope you all have a wonderful rest of your day and week. Thank you.
Thank you very much.